It begins with an abrupt policy change. The U.S. government announces that H-1B visas, the backbone of skilled foreign labor in technology, engineering, healthcare, and finance, will no longer be issued. Companies that have long relied on international talent to fill critical roles face immediate disruption. Jobs vacated by foreign workers are not easily filled, creating gaps in operations, product development, and strategic initiatives. The announcement triggers widespread uncertainty in corporate planning and investor sentiment. Stock markets react immediately. Technology-heavy indices such as the Nasdaq experience steep declines as investors anticipate reduced growth potential for companies reliant on H-1B talent. Publicly traded firms in software, hardware, and biotechnology sectors face uncertainty about project completion, innovation pipelines, and revenue forecasts. Market indices fluctuate wildly as investors reevaluate valuations based on talent, scarcity, operational risk, and slowed growth projections. The technology sector is the first and hardest hit. Silicon Valley, historically dependent on skilled international engineers, experiences immediate hiring freezes and project delays. Startups reliant on H-1B talent struggle to launch products, complete software development, or meet client commitments. Large corporations adjust resource allocation to compensate, but productivity losses are inevitable. Research and development timelines are extended, and competitive advantage erodes. Healthcare systems experience indirect but severe disruption. Hospitals, biotech firms, and medical research institutions relying on international doctors, nurses, and scientists face staff shortages. Clinical trials, medical device development, and pharmaceutical research slow down. Patient care is affected as specialized roles remain unfilled, creating operational bottlenecks in hospitals and laboratories. Corporate operations across multiple sectors are disrupted. Engineering teams, finance departments, and analytics groups reliant on H-1B talent encounter immediate gaps. Project timelines are extended, client obligations are delayed, and operational costs rise. Companies attempt to recruit domestic talent, but the domestic labor pool is insufficient to fill all critical positions, especially for highly specialized roles. Unemployment among domestic workers initially appears to improve superficially. Employers prioritize hiring domestic candidates to fill positions previously held by H-1B workers. However, skill mismatches prevent immediate replacement, reducing productivity and operational efficiency. Companies may retrain domestic workers, but this takes time and resources, creating short and medium-term economic drag. Immigration policy uncertainty further disrupts global business planning. Multinational corporations with U.S. operations reevaluate investment decisions. Expansion plans, research centers, and partnerships are delayed or canceled. International business leaders perceive the U.S. as a less predictable and welcoming environment for talent, creating long-term strategic shifts away from American markets. The banking and financial sector is indirectly affected. Investment in startups slows, venture capital funding becomes more cautious, and IPO pipelines are delayed. Stock market volatility increases as investors anticipate slower growth in tech-heavy sectors. Corporate bond markets are affected as firms with uncertain revenue streams face higher perceived risk, increasing borrowing costs. Consumer technology products face delays. Software releases, hardware innovations, and technological services dependent on specialized engineering talent are postponed. Product development cycles are disrupted, reducing corporate revenue forecasts and consumer availability. Competitive pressures increase as international competitors fill the innovation gap. Global trade and foreign investment are impacted. Countries that traditionally sent talent to the U.S. see reduced mobility and business engagement. International firms reconsider U.S. operations, outsourcing work to countries with more favorable immigration policies. Trade relationships, partnerships, and investment flows experience recalibration as talent mobility restrictions take effect. Corporate research and innovation slow significantly. High-tech industries rely on specialized skills often filled by H-1B workers. AI development, cloud infrastructure, cybersecurity solutions, and biotechnology research are delayed. Intellectual property generation decreases, reducing U.S. global competitiveness. Stock markets anticipate slower growth. impacting technology-heavy indices and valuations. Employment across domestic industries faces dual effects. While some domestic candidates fill open roles, overall productivity declines due to skill gaps. Companies attempt to retrain workers, implement automation, or outsource functions, but these solutions require capital and time. Economic growth slows, affecting GDP and corporate earnings. Stock market volatility persists. Technology, healthcare, finance, and biotech sectors experience valuation adjustments based on delayed growth and operational inefficiencies. Investors rotate into safer sectors such as consumer staples, utilities, and energy, reducing liquidity in high-growth industries. Market indices fluctuate in response to news, corporate earnings revisions, and policy updates. Corporate debt management becomes more challenging. Companies facing operational disruptions and slower revenue growth find debt servicing increasingly difficult. Credit agencies reassess risk exposure, raising borrowing costs. Bonds and loans tied to tech, healthcare, and research sectors experience higher yields, reflecting increased risk. Small and medium-sized enterprises are particularly vulnerable. Startups dependent on H-1B talent for critical software engineering, analytics, and research functions face existential threats. Venture capital funding slows as investors perceive higher risk. Many startups fail to launch products, reduce market reach, or cease operations, impacting innovation and job creation. Large multinational corporations adapt, but incur costs. Companies implement retraining programs, increase domestic hiring, and adjust project timelines. Operational inefficiencies rise, labor costs increase, and competitive advantage erodes as international talent migration to other countries accelerates. Corporate earnings forecasts are revised downward, affecting stock valuations. Financial markets experience systemic adjustments. Tech-heavy sectors, previously growth engines for Wall Street, slow dramatically. Indices adjust to slower growth and higher operational risk. Investors diversify portfolios away from H-1B dependent industries, increasing volatility in equities, ETFs, and mutual funds. Corporate valuations reflect uncertainty about talent availability, innovation timelines, and operational efficiency. Consumer behavior is indirectly affected. Technology products, healthcare services, and software solutions face delays or price increases. Limited availability and reduced innovation influence consumer choices. Industries dependent on rapid technological advancement experience slower revenue growth, while international competitors capture market share. Corporate risk management shifts focus. Companies adopt contingency planning to address talent shortages, invest in automation, and outsource functions internationally. Boards of directors prioritize operational resilience over growth, impacting long-term strategic investments. Risk-adjusted valuations reflect potential productivity gaps and slower innovation timelines. Global competitiveness of the United States diminishes. Countries with favorable skilled worker immigration policies attract talent that previously went to the U.S. tech, finance, healthcare, and research sectors in other nations accelerate growth, reducing American market dominance. Multinational corporations shift headquarters, R&D centers, and partnerships to alternative locations. Government revenue faces indirect stress. Slower corporate growth, reduced innovation, and lower international investment reduce tax revenue. Federal, state, and local governments face budgetary pressure, potentially impacting public services, infrastructure investment, and social programs. Fiscal strain is amplified by reduced corporate earnings and slower GDP growth. Innovation pipelines are disrupted. AI, biotech, software engineering, and medical research experience slower progress. Projects dependent on H-1B talent are delayed, reducing patent filings, product launches, and global competitiveness. Corporate strategy prioritizes existing revenue over innovation, reshaping long-term industry trajectories. Unemployment effects are uneven. Domestic labor absorption is constrained by skill gaps, leading to productivity loss. Workers face wage stagnation in certain sectors while specialized roles remain unfilled. Social tension emerges as companies struggle to balance hiring, retraining, and operational efficiency. Corporate profitability is affected across multiple sectors. Delayed projects, higher operational costs, and slower revenue growth reduce earnings. Stock buybacks, dividends, and investment plans are scaled back. Investor sentiment deteriorates, causing further volatility in equity markets. International investment slows. Foreign firms reconsider U.S. expansion, R&D collaboration, and market entry due to restrictive talent policies. Foreign capital flows decrease, affecting technology, healthcare, and research-intensive industries. U.S. financial markets adjust to lower investment inflows, impacting liquidity and growth projections. The venture capital ecosystem contracts. Startups reliant on H-1B talent face delayed product development, reduced scalability, and lower market potential. Investor appetite diminishes, reducing access to funding and slowing innovation cycles. Failure rates for early-stage companies increase, reducing job creation and technological advancement. Higher education faces indirect consequences. Universities dependent on international students experience enrollment decline. Research programs reliant on H-1B visa graduates slow down. Intellectual capital diminishes, affecting long-term innovation capacity and workforce readiness. Public perception and investor sentiment are shaken. Policy uncertainty, corporate disruption, and market volatility reduce confidence in long-term economic growth. Stock markets continue to fluctuate as analysts reassess sectoral exposure, investment strategies, and talent-dependent risk factors. Corporate restructuring becomes widespread. Firms reorganize to optimize domestic talent, implement automation, and mitigate skill gaps. Operational costs increase, efficiency declines, and competitive advantage is eroded. Companies that fail to adapt face declining market share, reduced profitability, or bankruptcy. Global trade adjusts. International competitors capture market share lost by U.S. firms unable to hire skilled talent. Supply chains, partnerships, and cross-border collaboration shift to countries with favorable talent policies. U.S. influence in technology, finance, and research declines relative to global peers. Labor market policies are reevaluated. Domestic workforce development programs, reskilling initiatives, and automation strategies are accelerated to compensate for lost H-1B talent. These programs require investment, time, and policy coordination, delaying immediate mitigation of skill gaps. Consumer markets experience downstream effects. Product availability, innovation cycles, and service delivery slow, reducing consumer choice. Price inflation may occur as operational inefficiencies increase production costs. Market competitiveness diminishes, creating opportunity for international firms. The energy, finance, and healthcare sectors face indirect disruption. Projects reliant on skilled foreign talent experience delays. Corporate risk, project cost, and timeline overruns increase. Market valuations adjust downward, reflecting uncertainty and operational disruption. Stock market recovery is slow. Investor confidence requires demonstration of sustainable corporate adaptation. Technology-heavy indices remain volatile as firms adjust hiring strategies, operational efficiency, and product pipelines. Long-term growth projections are recalibrated to reflect talent constraints. Ultimately, halting H-1B visas creates a cascade of economic and financial consequences. Corporate operations are disrupted, innovation slows, stock markets experience volatility, global competitiveness declines, and government revenue is impacted. Recovery depends on domestic workforce adaptation, automation, policy support, and strategic corporate investment. The scenario highlights the critical role of skilled foreign labor in sustaining U.S. economic growth, technological innovation, and global competitiveness. It underscores the interconnectedness of immigration policy, corporate strategy, and financial market stability in a highly integrated economy.